Assalamualaikum warahmatullahi wabarakatuh. We are from Group 6. We would like to present about the consolidated balance sheet with a less than wholly owned subsidiary. Before I start the explanation, let me introduce our group. My name is Rehan Siti Saada Sulaiman and my partner is Mufidah Tahara Fajri. I want to explain about consolidated balance sheet with a less than wholly owned subsidiary. Example is 80% ownership acquired at book value. Perles acquired 80% of special food outstanding common stock for 240,000 and amount acquired to 80% of the fair value of special food net asset on January 1, 2000x1. On this date, the fair value of special food individual assets and liabilities are equal to their book value. Thus, there is no differential because Perles acquired only 80% of special food common stock. The investment in special food equal 80% of the total stockholder equity of special food. It is $200 plus $100. So we can summarize special food ownership as fair value of Perles consideration. There are 240,000 at the fair value of the NCI interest. There is $60,000, and the total fair value consideration is 300, and the book value of special food net asset include common stock special food. There are 200, retained earning special food $100, so we get $300, and the difference between fair value and Perles record the 80% stock acquisition on its book with the following entry on January 1, 2000x1. The first is investment in special food in debit 240,000 and cash in credit 240,000, and we did the description record purchase of special food stock. And the next is the basic investment elimination entry. The basic elimination on the date of the acquisition will be the same as the one illustration in chapter 2, except that the $300 book value of net asset is now jointly owned by Perles is 80% and the NCI shareholder is 20%, shown in the breakdown of the book value of special food. Book value calculation is the beginning of book value. NCI 20% plus Perles 80% equal common stock plus retained earning. As we know the NCI 20% is 60,000 plus the Perles 80% is 240,000 equal the common stock is 200 plus retained earning is 100, and the journal entry, the basic elimination is common stock in debit 200, retained earning in debit 100, and investment in special food in credit 240,000, and the last NCI in NA of special food is 60,000. Next is the relationship between the fair value of the consideration given to acquire special food, the fair value of the special food net asset, and the book value of special food net asset can be illustrated as the following example from Perles investment acquire exactly 80% of the net book value of special food asset. So there no goodwill is recorded, and all asset and liability are only combined from special food financial statement as their current book value. So you can see the goodwill is 0, identifiable assets is 0, and 80% book value is 240,000. Next is the elimination entry. Simply credit the investment in special food stock account for the original acquisition price $240,000 from Perles balance sheet. So there is the T account of investment in special food from acquisition price is $240,000 and from the basic elimination entry is 240,000. Next is the optional accumulated depreciation elimination entry. Elimination the odd accumulated depreciation of the subsidiary as of the acquisition date and netting it out again the historical cost. Give the appearance that the depreciable assets have been newly recorded at their fair value as of the acquisition date. In this example, Special Food had accumulated depreciation on the acquisition date of $300, and the following elimination entry net this accumulated depreciation out again the cost of the building and equipment. So the accumulated consolidation worksheet, it is present a consolidated worksheet. In full consolidation, the asset and liabilities of the individual subsidiary are combined with parents, including the net asset of the subsidiaries. Therefore, the investment account has been eliminated and is not included in the consolidated balance sheet. You can see from the worksheet for consolidated balance sheet account that delete are account investment in special food, common stock, retained earning, and NCI in NA of special food. And the last is figure 3.1 about consolidated balance sheet January 1 to 2000x1. That's about combination 80% acquisition at book value. In figure 3.2 show consolidated balance sheet that is prepared from consolidation worksheet at the acquisition date. Because no operation occurred between this date combination and preparation of a consolidated balance sheet, no income statement or statement of retained earning.
Okay, my name is Mufida Tahara. I will explain about consolidation subsequent to acquisition, 80% ownership acquired at book value. More than a consolidated balance sheet, however, is needed to provide a comprehensive picture of the consolidated entity's activity following acquisition. As with a single company, the set of basic financial statements for a consolidated entity consists of an income statement, a statement of change in retained earnings, a balance sheet, and a statement of cash flow. Each of the consolidated financial statements is prepared as if it is taken from a single set of books that is being used to account for the overall consolidated entities. As in the preparation of the consolidated balance sheet, the consolidation process starts with the data recorded on the books of the individual consolidating companies. The account balance from the books of the individual companies are placed in the three-part worksheet, and entries are made to eliminate the effect of intercorporate ownership and transaction. The consolidation approach and procedure are the same whether the subsidiary being consolidated was acquired or created. Next one is initial year of ownership. For the example, assume that Peerless already recorded the acquisition on 1st January 2000x1 and that during 2000x1, Peerless record operating earnings of $140,000, exclude its income from investing in special food, and declare dividend of $60,000. Special Food report 2000x1 net income of $50,000 and declare dividend of $30,000. The second is parent company's entries. Peerless record its 2000x1 income and dividend from special foods under the equity method as follows. The first journal is investment in special foods in debit and income from special foods in credit with amount $40,000. It is record Peerless 80% share of special foods 2000x1 income, that is $50,000. And the second journal is cash in debit And in credit is investment in special food with amount 24,000. It is record peerless 80% share of special foods 2000 x1 dividend. That dividend amount is $30,000. Consolidation worksheet, initial year of ownership. In this example, the accounts that must be eliminated because of intercorporate ownership are the stakeholder equity accounts of special foods, including dividend declared, peerless investment in special food stock, and peerless income from special foods. However, the book value portion of peerless investment has changed since the 1st January acquisition date because under the equity method, Peerless has adjusted the investment account balance for its share of earnings and dividends on entries 2 and 3. The book value of portion of the investment account can be summarized as follows. At beginning book value, it is from calculation NCI 20% plus Peerless 80% equals to common stock plus retained earning. On beginning book value, NCI to 20% is 60,000 is from 20% of 300,000. And Peerless 80% is 240,000 equals to common stock is 200,000 plus retained earning 100,000. The next step is we must plus net income and NCI 20% is 10,000. It is from 20% from 50,000 and the Peerless 80% is 40,000 and equals to retained earning 50,000. The next step is we must minus with dividends and dividends NCI 20% is 6,000 is from 20% of 30,000 and so the Peerless 80% is 24,000. Then we calculate all of them. So the ending book value NCI 20% is 64,000 and Peerless 80% we get the 256,000 and the common equals to common stock is 200,000 and retained earnings 120,000. So we can see on the 1st January the 80% of book value is 240,000 is initial investment in special food, but in the 31st on December 80% of book value is 256,000. It is ending net investment in special food. Next is basic elimination entry. The basic elimination entry remove both of the investment income reflected in the parent's income statement and any dividend declared by the subsidiary during the period. So the basic elimination entry on debit is common stock with amount 200,000. It is from common stock balance. Retained earning with amount 100,000. It is from beginning RA from trial balance. Income from special food 40,000. It is from Peerless share of special foods NI and NCI in NI of special foods with amount 10,000. It is from NCI share of special foods reported NI. And on the credit is dividends declared with amount 30,000. It is from 100% of subsidiaries dividends declared. Investment in special foods to 256,000. It is from Peerless share of book value of net asset. And the last one is NCI in NI of special foods with amount 64,000. It is from NCI share of book value of net asset. Because there is no differential in this example, the basic elimination entry completely eliminates the balance in Peerless investment account on the balance sheet as well as the income from special food accounts on the income statement. The first one is in the investment in special food. On debit, the first one is acquisition price is 240,000 and 80% of net income is 40,000, and in credit is 80% of dividend, so we get the 24,000. So the ending balance is 256,000. And in credit there is basic entry with amount $256. So there is no differential. And in the income from special food, in credit there is 80% of net income. So the amount is 40,000, and ending balance so the ending balance is 40,000 and the basic entry is 40,000, so there is no differential too. And next is optional accumulated depreciation elimination entry. The journal is accumulated depreciation on debit, and on the credit is building and equipment with amount 300,000. It is accumulated depreciation at the time of the acquisition, net again cost. And for the accumulated depreciation elimination entry, it is to appropriately present this asset in the consolidated financial statement as if they had been purchased on the date of subsidiary was acquired at their acquisition date fair value. Next is second and subsequent years of ownership. Parent company interest. Consolidation after 2 years of ownership is illustrated by continued example of Peerless products and special foods. Peerless separate income from its own operation for 2000X2 is $160,000 and its dividend total $60,000. Special foods report net income of $75,000 in 2000X2 and pays dividend of $40,000. Equity method entries recorded by Peerless in 2000X2 are as follow. The first one journal is investment in special food on debit, and And on credit is income from special foods with amount $60,000. It is record peerless 80% share of special foods 2000 x2 income, and the amount is 60,000 is from 80% times $75,000, so we get the $60,000. And the next journal is on debit is cash, and on credit is investment in special food with amount $32,000. It is record peerless 80% share of special foods 2000 x2 dividend. $32,000 is from 80% times $40,000. After we calculate all of the entries, we write in the elimination entries. So if we calculate to the right side, so we get the amount of the consolidated. Thank you for your attention. Wassalamualaikum warahmatullahi wabarakatuh.